Welcome to the week that was. If you just glance at the ticker on your phone right now, the first impression is, well, calm.
Receptive calm.
Yeah, even boring. Bitcoin seems trapped in this really tight consolidating range, just bouncing around. It really looks like the market's just waiting for the holidays to be over.
And that surface calm is, as you said, completely deceptive. It's masking what we're really seeing, which is this fundamental structural divergence.
Divergence between what and what?
Between the price action, which looks weak and indecisive, and where the smart money is actually going.
Okay.
I mean, we are witnessing a quiet, almost violent transfer of ownership. Regulated infrastructure is being built under the radar, and all the weak hands, capitulating miners, retail sellers who are panicking, they're handing their supply directly over to institutional desks.
Okay, let's unpack this. Because you're right, beneath that stagnant chart, we had a massive volatility suppressant, a really critical liquidity stress test, and even a geopolitical power play, framing Bitcoin as not a currency, but a strategic resource. So our mission in this deep dive is to analyze the fallout from that $90,000 price rejection, really dissect the institutional plumbing that Wall Street is installing, and examine the systemic security challenges that just gave the industry a pretty serious scare.
A very serious scare.
So let's start with that price failure. We closed the previous week, basically confirming a rejection at that critical $90,000 resistance level.
Yeah, the market just could not pierce it, not after that big Q4 correction.
So what does that mean for the technicals right now?
Well, that failure to break 90K means the short-term picture is, frankly, leaning bearish. We've established a pattern now of lower highs.
Right.
And if you look at the structure, you're just seeing buyer exhaustion. Momentum is with the sellers. The indicators are, clearly sitting below that neutral 50 threshold.
So where is the critical defense line? Where does it have to hold?
The immediate demand floor is around 87,600. But the absolute critical line in the sand, the level that really defines this whole structure, that's a bit lower. It's around the 80,500 to 80,600 region. If the market breaks below that, we could see the kind of liquidity flush we've been talking about, the one needed to finally transfer that last bit of supply.
But this tight range, it wasn't just random market noise, was it?
Not at all. And here's where it gets interesting. This was mechanically imposed by the derivatives market.
This is what I wanted to get into. We had the expiration of, what was it, around $27 billion in crypto options contracts?
$27 billion. And that sounds technical, I know, but it had a very real, very physical impact on the price.
How so?
It created something called gamma pinning. The simplest way to think about it is this. The big market makers who sold all those options, they need to hedge their risks.
They don't want to bet on which way the price goes.
Exactly. They have to stay neutral. So to manage their exposure, they mechanically bought every dip and they sold every rally. That hedging acted like a giant invisible rubber band.
A rubber band. I like that.
Yeah, just dampening all the volatility and pinning the price pretty much precisely between $85,000 and $90,000.
So the consequence is that now, with the expiration over, that pin is gone. The rubber band is snapped.
Precisely. We are now entering what you could call a coiled spring dynamic. And historically, when a mechanical stabilizing force that large is removed, volatility expands rapidly.
So the quiet period is over.
Almost certainly. Whether it resolves up or down, we'll see. But the market is tense.
And you've got to add the spot market behavior to that tension. I mean, 5 straight days of net outflows from the U.S. spot ETFs.
Over $825 million for the week.
And you have to look inside those numbers, right?
Yeah.
Because even BlackRock's iBet.
The one that only ever seems to buy.
Right. Even that fund registered rare, pretty substantial outflows on 2 different days.
And that's a clear signal. It tells you major institutional allocators are doing some aggressive year-end tax loss harvesting, rebalancing their books.
Yeah.
They are actively pulling away that constant passive institutional buying pressure that the market had gotten used to.
Which brings us right to this great divergence you mentioned. It's like institutional Wall Street versus corporate strategy. Huge outflows on one side, but then a tier 1 bank is finally building the on-ramp.
Well, that's the biggest infrastructure news of the week, no question. JPMorgan Chase's entry.
So what are they actually doing?
They're finalizing plans for a dedicated spot and derivatives trading desk for digital assets. For the massive hedge funds, the pension desks, the ones waiting on the sidelines. The single biggest bottleneck has been the lack of a tier 1 prime broker.
Why is a prime broker like JPMorgan so crucial for them? Can't they just go to a crypto exchange like everyone else?
No, they really can't. Not in a way that's compliant and efficient for them. They need to trade crypto right alongside their foreign exchange and commodity books using the same plumbing.
And at their margins and all that?
Exactly. Reduce collateral requirements. So JPMorgan is facilitating this with the OCC greenlit riskless principal model.
Okay, break down riskless principal for us, simply.
Think of JPMorgan as the world's most sophisticated matchmaker. They aren't taking a side in the trade. They're an instant pass-through. They match a buyer with a seller and use the bank's balance sheet for just a fraction of a second to get the trade done.
So they take almost zero risk themselves.
Almost zero directional risk, but they facilitate billions in flow. And this is monumental because it validates Bitcoin as an investable commodity in the eyes of regulators. It pulls it out of the pure speculation bucket and opens the floodgates for compliant capital.
Now, you have to contrast that banking embrace with the biggest corporate holder out there, MicroStrategy.
Right.
They just sat on the sidelines this week. They bought 0 BTC.
Mm-hmm.
And this is while they're sitting on a massive cash pile of over $2.19 billion.
That pause,
Right.
That signals a huge strategic shift. They've gone from what was basically machine gun strategy, just buying, to more of a sniper strategy.
What do you mean by that?
By sitting on that cash, they're creating this giant liquidity buy wall. It can be deployed instantly to defend their cost basis or to violently capitalize on a big structural flush.
So the biggest buyer is now waiting for a dip.
They're now highly price sensitive, yes. And they're willing to wait for that volatility expansion we just talked about.
But isn't just sitting on $2 billion in cash during a period of high inflation just risky? Aren't they losing money just by waiting?
That's the tension, isn't it? They're making a calculated trade. For them, the risk of waiting is now less than the risk of deploying that cash at a high price and then watching it drop. Their calculus has changed. It's all about maximum acquisition efficiency now.
And adding resistance to this whole picture is the macro backdrop, this macro liquidity paradox. The U.S. reported really strong Q3 GDP growth.
4.3%. It beat expectations by a lot.
And what does that do?
Well, strong GDP, especially with core inflation still being sticky, it reduces the chances of aggressive Fed rate cuts anytime soon. And when the Fed is less likely to ease, Treasury yields go up. That increases the opportunity cost of holding something that doesn't yield anything, like Bitcoin.
So money rotates out.
We saw capital rotate back into traditional assets. The S&P 500 hit record highs while Bitcoin was just stuck. It momentarily shifted Bitcoin's story from sovereign hedge to high beta tech stock, very sensitive to the cost of money.
Let's shift from balance sheets to geopolitics then. You mentioned a governance paradox developing in the U.S. regulatory space.
Yeah, the paradox is that you have these simultaneous moves. One is toward sensible integration, and the other is toward political scandal.
Okay, what's the bull case?
The bull case is the Bipartisan Digital Asset Parity Act. This proposes a de minimis tax exemption, so it would eliminate capital gains reporting for any transaction under $200.
And why is that $200 limit such a game changer?
Because right now, every single time you spend crypto, $5 for a coffee, $50 for a sweater, it's a taxable event.
Which is a nightmare to track.
Yeah. It makes mass adoption impossible. Getting rid of that reporting for small payments solves the single biggest hurdle to using these things as actual currency, not just an investment.
But the other side of that paradox.
The other side is the Blanche memo scandal. The revelation that Deputy Attorney General Todd Blanche held significant crypto assets while he was issuing a key memo directing the DOJ to ease up on investigations. That creates massive headline risk.
A huge perceived conflict of interest, even if the assets were gifted away later.
Precisely. It invites political pressure. It invites scrutiny. It could undermine that measured, light-touch regulatory approach that so many were hoping for. Critics can now claim policy is being influenced by personal finances. It's a big vulnerability.
Meanwhile, other global powers are formally integrating Bitcoin into their statecraft.
Look at Russia. The central bank governor came out and formally stated that Bitcoin mining is actively contributing to the ruble's strong exchange rate. That is state sanctioning. They're using a digital resource as a geoeconomic tool, using mining to generate foreign currency and get around sanctions.
And then you have that extraordinary claim from Putin about the Zaporizhia nuclear power plant.
That allegation is fascinating. That the U.S. is negotiating to use the ZNPP's surplus energy for industrial-scale crypto mining.
Is there any truth to it?
Whether it's true or not almost doesn't matter. The act of saying it frames hash rate as a strategic resource, something that can bypass sanctions, monetize stranded energy, even in a conflict zone. It elevates the whole conversation from speculative asset to strategic infrastructure.
And this plays right into China's strategy, right? They're reinforcing their dominance in the hardware supply chain.
They're doubling down. They launched a massive 100 billion yuan venture capital fund specifically for hard technology like integrated circuits.
So even though they banned the token,
they recognize that controlling the silicon, the actual chips that power both mining and the AI sectors, gives them geopolitical leverage no matter what Bitcoin's price does.
we're seeing corporate adoption evolve, too. I thought the Norway Sovereign Wealth Fund news was huge.
A major precedent. You have one of the strictest ESG-focused investors in the world backing a Japanese firm's move to issue preferred stock to buy BTC.
It shows there's a compliant way in.
It professionalizes the whole corporate treasury strategy. And then you saw Tether executives acquiring Northern Data's mining arm. $200 million. They're consolidating direct control over massive mining capacity, basically vertically integrating their whole operation.
Speaking of mining, let's talk about that industrial pivot. Miners like Cypher are shifting towards high-performance computing, or HPC. This feels like a game changer for how they're valued.
It's a profound shift. Think of it like a farmer who realizes the land he's using for, say, corn, which is volatile and weather-dependent, is actually far more valuable as a parking lot for a giant factory. Miners are realizing their infrastructure, the land, the power hookups, the cooling. It's perfect not just for mining, but for hosting AI compute. Cypher was very clear about its new Ohio site being ideal for HPC to stabilize their revenue.
So they're actively trying to change their valuation model, move away from just being a commodity producer.
They want to become digital infrastructure REITs, real estate investment trusts. REITs are valued on the stable, high-margin rental income they generate from their infrastructure, not on the price of a commodity.
So it decouples their stock price from Bitcoin's volatility.
Which is exactly what sophisticated investors have been demanding.
Let's finish up with the systemic stress test the industry just faced, the fragility of trust, both in the money layer and the user layer.
The stablecoin sector had a really critical moment. S&P Global Ratings downgraded Tether, USDT, to their lowest possible stability score. They labeled it weak.
That's a huge reputational hit. What was the critical reason?
It was this idea of a circular dependency that they found in Tether's balance sheet. Bitcoin now makes up about 5.6% of its reserves.
Meaning if Bitcoin falls hard.
The collateral backing the world's most liquid stablecoin also falls. You're backing a dollar-pegged liability with a highly volatile asset. You're basically building market beta directly into your stability mechanism.
And this fragility wasn't just theoretical. We saw real-world problems.
Oh, yeah. The Solana-based USX stablecoin had a catastrophic depeg. It dropped to 10 cents. Just a total liquidity drain. At the same time, big banks like JPMorgan were aggressively freezing accounts of stablecoin startups linked to high-risk places like Venezuela. The traditional system is enforcing compliance.
We also saw this big split in DeFi governance, which suggests investors are getting, well, more demanding.
You saw two totally different outcomes. Uniswap's community overwhelmingly approved a proposal to burn tokens and, more importantly, activate the fee switch.
They want a piece of the action.
They want tangible value accrual. Fees, not just voting rights.
But the OV community rejected a similar proposal.
They rejected it. The institutional stakeholders argued it was just a transfer of liability without any clear economic upside for the token holders. The market is maturing. They are demanding real economic benefits now, not just governance theater.
And finally, the big security scare, the trust wallet hack.
That $7 million loss is terrifying. It's terrifying because it wasn't some complex smart contract exploit. It was basic client-side Web 2 risk.
What happened exactly?
A supply chain attack. Malicious code was injected into a browser extension update. It just harvested seed phrases directly from the user's browser. It was a high-tech phishing attack in disguise.
And the founder of Binance, CZ, he committed to covering the losses.
Yes, which sets a very costly precedent. It highlights that these wallet providers are, by necessity, becoming insurers for client-side risks, not just key holders. It's a stark reminder that the weakest link is still the user interface.
So let's bring it all together. What's the summary of the week?
The price consolidation is fundamentally masking this massive structural transfer of ownership from retail to institutions. But what's really critical is the decoupling we saw. Gold and silver soared on geopolitical hedging, right? Bitcoin sat it out.
What does that tell you?
It confirms that right now, big money allocators view BTC not as a sovereign hedge during acute stress, but more as a high beta risk-on tech stock that's still sensitive to interest rates.
So for you, listening, you should probably view this calm as the market just taking a breath before a major move. Keep a very close eye on that $86,000 support level now that the options pin is gone, and monitor the legislative progress in the U.S. and Europe. So what's the final question this week's divergence raises for you moving forward?
The industrial pivot of Bitcoin miners. The emphasis on HPC and AI hosting over pure mining, it indicates the market is re-rating that whole infrastructure sector. So the provocative thought you should mull over is this. Are mining rigs still just commodity producers? Or are they evolving into indispensable, high-margin digital infrastructure REITs that can generate stable returns, regardless of whether the underlying token price is going up or down?
A completely different asset class.
That fundamental shift in valuation could open up a whole new class of investment, one that's entirely decoupled from market volatility.